my right, we have John C. Williams, President and CEO of the Federal Reserve Bank of San Francisco.
I'm very happy to be here.
And last but certainly not least, we have Eric Rosenberg, President and CEO of the Federal Reserve Bank of Boston, and his counterpart in New York, President William Dudley.
Thanks, Greg. Hi, Greg. Thanks for having me.
And congratulations on the upcoming retirement.
Thank you, Greg. I'm looking forward to it.
The economy is in a state of mixed indicators currently. However, consensus generally maintains that we're doing reasonably well. Both the labor force participation rate as well as the U3 unemployment rate have trended downward recently. U.S. equity indexes have reached all-time highs, but the 10-year Treasury continues to trend up, albeit gradually. Monthly PCE readings suggest that core inflation may be stabilizing at a new level, markedly lower than the FOMC's long-run objective, which brings us to one of today's main topic points: long-run real rate of interest. According to Ghanaian CEO of the Cleveland Federal Reserve 2017, it is the short-term interest rate expected to prevail over the long run if the Fed is achieving its dual mandate. Excuse me. It is the equilibrium level of real interest rates, otherwise known as the natural rate, and will henceforth be referred to as R star. That brings me to my first question. President Williams, could you give the audience a brief description of R star and its importance to the Fed?
Absolutely, Greg. As you can see here, R star is what inflation-adjusted interest rates would be in an economy at full strength employment. As explained in my August 2016 economic letter, R star is a function of the economy that is beyond the influence of the central bank. It tends to share characteristics of secular stagnation, where both interest rates and inflation are persistently low.
To interject here, John, a low R-star environment poses a significant threat to our economy if a recession were to occur. Conventional monetary policy loses all efficacy at the zero lower bound.
Governor Brandon, I wonder if you might explain the underlying reasons for R-star and how it will affect the Fed in particular.
Sure, Greg. The equilibrium real interest rate may have fallen for many reasons, namely the inclusion of a slower rate of technological progress and the demographic transitions associated with the aging of baby boomers.
Tightening our policy further may be conducive in achieving our target inflation rate. However, I do believe that there's more we ought to consider. We should start with policies that aimed at raising R star by affecting its underlying determinants, those being the global supply and demand for funds, shifting demographics, slower trend productivity, economic growth, emerging markets seeking large reserves of safe assets, and dearth in global savings.
Moving the conversation slightly, if I may, how does inflation figure into all this?
There seems to be a disconnect between full employment and a lower than projected inflation rate, suggesting a breakdown of the Phillips curve. As you can see from the slide, core inflation as measured by PC price index slowed by almost 50 basis points compared to the pace a year ago. Since 2012, inflation has tended to move relatively little while unemployment rate has fallen considerably. I feel that we ought to be cautious about tightening our policy further. That is, at least reasserted inflation is on target. Before setting monetary policy, we should give serious consideration to the issue of persistently low inflation.
I view inflation as more of a transitory issue rather than a structural one. According to the University of Michigan Survey of Consumers, expected inflation for next year is bound to be 2.4% and 2.5% for the next 5 years. We should be pressing forward with our current conventional policy tools in an effort to curb any possible negative consequences of a recession.
Eric, if I could just jump in here. Inflation persistently below our 2% target has been troubling. To your point, some of the more recent events may be transitory in nature, but the overall persistence of current low inflation suggests more structural changes are taking place.
Here, as you can see from the slide, tip spread compared to a pre-crisis norm of 2.5%, we now see that number has dropped significantly over the past decade. According to the standard New Keynesian policy equation outlined by Michael Woodford in 2003, inflation tends to remain low when expected inflation remains low.
Tightening our policy further may be conducive in achieving our low R star environment and our target inflation rate. However, there is more we ought to consider. We should start with policies aimed at raising R star by affecting its underlying determinants. As I stated before, those being the global supply and demand for funds, shifting demographics, slower trend productivity, economic growth, emerging markets seeking large reserves of safe assets, and the global dearth in savings.
We'll get to policies to combat low R-star later in the segment, but for now that brings us to the next part of our panel. Former Vice Chairman Fisher identified a major concern with low interest rates, namely that they signaled the economy that growth potential may be limited. Mr. Rosenberg, you've been adamant in your position that actual GDP growth is now exceeding that of potential GDP growth. Could you nuance this contention for us?
Absolutely, Greg. So as I said in my speech to the Central Vermont Chamber of Commerce in May, my own estimate of potential GDP growth at this point is 1.75%. Now this number reflects what I believe to be the maximum sustainable growth rate in the economy thus far. This, however, as you can see in the graph, contrasts to the 2% average growth rate we have seen during the recovery recovery is surpassed now in both Q2 and Q3. It is my view that this means that the United States economy has reached a point where we are overheating and signals the need for the Fed to act and act now.
Greg, if I could just jump in here for a moment, I have a little bit of a different outlook I'd like to present. As I stated in September at the Money Marketeers of New York University event, I believe the U.S. economy still has room to grow. The labor market is steadily improving as evidenced by solid job gains and recent unemployment trends. I expect the labor market tightening will continue and ultimately lead to the wage push we've been expecting. Furthermore, the labor market tightening will no doubt precipitate increased business investment in labor-saving technologies as a means to reduce costs. These factors should ultimately lead to greater consumer spending and increase in business investment, in turn helping spur inflation.
Now, Bill and I are friends here, but he knows I have to add a couple of counterpoints of my own. First off, as I said in Montreal this past month, maintaining real low short-term interest rates once we have achieved full employment risks the potential of an overheating economy, which could be referenced by higher prices, wages, and asset prices that, Bill, we are now starting to see grow at 45-degree angles. Furthermore, overshooting the natural rate of unemployment is also very dangerous. As referenced by Stuart Weiner in 1986, overshooting the natural rate will only lead to higher inflation and higher unemployment in the long run.
Yes, however, I have a few counterpoints of my own I need to raise here. If you look here, you can see total non-farm positions in the U.S. are still trending upward and now reaching record levels exceeding 6 million. Moreover, the labor market is really not as strong as the 4.1 Q3 rate suggests, as you can see here, looking at the participation rate. Additionally, rising homeowner equity levels and equity prices are creating healthier balance sheets for households, which should create more economic growth. Second, I'd like to point out that before unemployment rates would rise in your example, we'd see signs of higher inflation. As highlighted earlier, inflation is still persistently below our 2% goal.
Bill, you bring up some good points, but this is just practicing reactionary monetary policy. As you can see in the graph, we are already starting to see signs of wage growth.
Refocusing the conversation, most of this discussion thus far has been centered on the domestic. I'd like to shift towards the international economy. Who would care to start us off?
Greg, if I could just jump in here. You can see growth across major advanced economies has been steadily improving. Improvements to global output is a propitious sign for global trade and growth. Additionally, unemployment rates are also trending downward, signaling a favorable international outlook.
Given the international focus, China's producer price index surged to 6.3% in August from a year earlier. According to IMF, growth output has been revised up for Japan and especially the euro area, where positive surprises to activity in late 2016 and early 2017 point to solid momentum.
Given this North Star paradigm and the possibility of low interest rate era, what should the Fed do moving forward? Specifically, what actions ought the Fed embark on moving forward? President Williams, would you give us your policy recommendations?
I'll happily take that, Greg. A potential solution would be an increase to longer-run growth and prosperity by way of long-term investments in education, public and private capital, and research and development. These are all solutions that were highlighted in our economic letter back in San Francisco.
Interesting. A high inflation target may be better suited for a low R-star paradigm. President Roosevelt, could you flesh this out for us?
Last month, I noted that this could be a discussion we have in the future, but now, however, before my colleague goes and alerts CNBC, let me kind of explain what I mean a little bit. I don't see raising the inflation target as much of a tool to fight this low inflationary environment we're in, but more so as a tool to fight this low R-star environment we find ourselves in. I agree with Chair Yellen as she said in the June FOMC press conference, this could be a discussion we have at some future time. Once we hit our inflation target, which I believe will come next year, and also according to inflation expectations, it could be time to have that conversation. However, until then, we must stay the course.
Well, that's an interesting reflection. President Williams, perhaps in a more directed way, could you answer the question of how flexible price level targeting or nominal GDP targeting would be better suited to tackling our side?
Absolutely. With the flexible price level or nominal GDP targeting framework, the central bank targets a steadily growing level of prices or nominal GDP as opposed to the rate of inflation. A potential advantage is the fact that it limits interest rates once they reach the lower bound because it automatically delivers a lower for longer policy prescription as described by Egerton and Woodford in 2003. Additionally, nominal GDP targeting has a built-in protection against debt deflation, according to Kane in 2013 and Sheedy in 2014.
So given this conversation we've had about R-star, interest rates, and growth, I'd like to turn the conversation and pose a question to the entire panel. How does this inform your opinion on Fed policy in the near term?
As I said in my speech in September, Further adjustments to the federal funds rate should be determined after we see more proof that inflation is trending upwards towards the 2% target. Returning inflation back to target is especially important given that once interest rate return to a normal level, they're likely to be much lower than in the past, given the fact that less room to maneuver should the economy weaken. In my view, the neutral level of the federal funds rate is likely remain close to zero in the medium term.
Love brings up an important issue about the effective lower bound. Essentially, this is the point where interest rates are already so low we have no further place to drop them from in order to increase the money supply, increase demand, and thus fight off a recession. With that, I believe a rate hike in December would prove advantageous in helping us reach our near-term goals with our current conventional policy tools. Excuse me. Raising rates now will afford us better damage control when, and notice everyone on this panel that I say when, the next recession manifests. As I've said, conventional monetary policy loses all efficacy at the zero lower bound. Although we do agree we are in a rate rising environment, we do not want to test the waters of negative rates as they did in Europe. The ECB is just now starting to talk about ending its bond purchasing program in September of next year, much further behind than our own selves.
To Eric's point, we have begun tapering our asset purchasing program in order to return to the use of more conventional monetary policy. Allowing assets to gradually roll off our balance sheet will decrease the money supply and subsequently result in higher rates.
See, you all bring up very good points, but I think we could consider a higher inflation target. I believe there needs to be a combination of both conventional and non-conventional monetary policies, while acknowledging that there's only so much that monetary policy can do. At this point, our focus then should shift towards things that we underinvest in, like early childhood education and health, secondary and higher education, job training, infrastructure, basic research and development, for instance. These are all things that drive an economy and prosperity in the long run.
John, you brought up some good points, but we can't wait around for inflation anymore. We should be a proactive Fed and not a reactive one. But you are right, we could be open to unconventional policy tools down the road to help us achieve our dual mandate. As I've stated, we should be looking to stave off an overheating of the economy. Just to give the panel a few ideas of what I'm looking at when I say that. I'm seeing a 30% rise in the S&P 500 Transportation Index just this year, which tends to be a great leading indicator of future economic expansion. Add to that extremely low unemployment with further fiscal stimulus on the way, and round it out with both increases in GDP growth and wage growth all this year.
To John's point, I believe there will be a time to consider the use of more unconventional monetary policy if inflation remains below our 2% target. However, at this point in time, I will restate the same message I gave in October. I expect the U.S. economy to continue on its current trajectory with further improvements to the labor market leading to wage growth and ultimately inflation. The proper response to these conditions is to gradually remove monetary policy accommodation. Therefore, I agree with my colleague from Boston that a 25 basis point rate hike come December is warranted.
So the consensus of the panel seems to me to be that the economy has a positive outlook as evidenced by wage growth, employment, and strong asset prices. Most seem to be in favor of rate hikes, some more eager than others, of course. Furthermore, we ought to keep a keen eye on inflation and possibly revise the target higher. Moving forward, we ought to think about a possible 25 basis point rate hike in December. I think it seems prudent.
Yes, that is an accurate adumbration of future monetary policy outlook. There is a strong case for a 25 basis point rate hike come December. We expect to continue on our current balance sheet normalization process. Looking further ahead, we may begin to reevaluate our inflation target if inflation persistently misses our 2% goal. However, it is important to reiterate, we are a data-dependent Fed and future policy will be predicated on the economic data.
And that concludes our conversation. I'd like to thank all of our esteemed guests, and we'll open the floor to questions now.
Thank you. So you let us know. You can begin whenever you're ready.
Thank you for your time and your presentation. We have two anchor questions, so we'll ask all of them the same two questions, and that's how we'll start, and then we'll just go around. Do you want me to pick it up? So my first question is, how does the Fed currently manage the Fed funds rate?
Yeah, so I can take that question. The Federal Reserve manages the federal funds rate through its open market operations by either buying or selling bonds. And when the Fed buys bonds, it basically by buying bonds, it increases the money supply, which lowers rates, and by selling bonds, the the Fed lowers the money supply by raising rates.
Okay, all right. What role does the balance sheet of the Fed play in conducting monetary policy?
Alright, so your question was in regards to the balance sheet and kind of its role in the monetary policy. So just to start off, I want to give a little bit of background on the balance sheet. It's currently at $4.45 trillion. Most of the 1.8 trillion is of mortgage-backed securities, with the rest being primarily U.S. Treasuries. This is significantly higher than the level we saw pre-financial crisis, which was roughly $700 billion in 2007, roughly. This increased drastically due to several phases of quantitative easing, which was implemented to stimulate economic growth. I'd like to pass this question off to the narrator, who can talk a little bit more about the process.
Yeah, so the Fed is currently undergoing unwinding its balance sheets. Per the June 14th addendum, the committee anticipates $6 billion a month in treasuries to roll off the balance sheet, with another $6 billion increase every 3 months. As far as MBSs are concerned, dovetailing off the 1.8 trillion that my partner mentioned, MBSs are expected to roll off at $4 billion a month, with an increase of $4 billion every other third month, up to $20 billion, and it will continue that way throughout. There's talk of unwinding the balance sheet back to around the level, but slightly above the level it was in 2000. As he referenced, that was roughly $700 billion before we went into the phases of quantitative easing after the financial crisis. Now I'm going to pass that off to.
Some things to look at when we are unwinding the balance sheet is credit spreads. Credit spreads have been thinning since our 4 rounds of QE. Unwinding the balance sheet could move the yield curve. It is yet to be seen how that yield curve will move, whether we'll see it on the long end or the short end. So that we'll really be able to tell once we get into this a little bit. Furthermore, there has been a drastic buildup in the equity markets of late. The price to earnings on the S&P 500 right now is about 25 times, compared to a historical average of about 17 times. These low interest rates have really led investors to search for yield and returns into riskier assets, which kind of built up this artificial equity market surge we've been seeing. And so as we continue to unwind the balance sheet, we'll have to monitor on how we'll monitor on interest rates, where those go, and the yield curve.
To kind of build on that, looking at the equity markets, it's important to take into consideration a lot of the evaluation methods use weighted average cost of capital as a discount rate. This could be significantly impacted by quantitative unwinding the Fed's balance sheet, because it could lead to higher rates. As rates rise, the cost of capital for businesses will increase, and subsequently valuation models will likely yield smaller intrinsic values as the discount rate is increased. Another important factor to consider with rising rates is the student loans.
Yeah, which are roughly sitting at 1.3 trillion currently, and according to the latest Census Bureau statistics, the class of 2016 roughly has $37,172 in student debt. So suffice it to say that is a looming elephant in the room.
Thank you. I think, sorry to interrupt you, but we're just gonna move on.
Okay.
Yeah.
Great. Maybe just dovetailing on the comment that you talked about the equity market, I wondered what could some of the impacts, I guess, of your policy recommendations have? You know, you always have to worry about unintended consequences, but what do you think that kind of impact could look like?
So your question was in regards to kind of monetary policy impacting the equity markets. Immediately, we do not see a significant impact. Most economists or most big firms already have the 25 basis point rate hike for December written into their books. So we don't see that having a huge impact. Moving forward, it will be important to monitor the unwinding of the Fed's balance sheet, simply because something of this magnitude has never been undertaken. So all the effects of this process are yet to be determined. So it's important.
I agree with my colleague that the rate hike in December has already been factored in. When the Fed hiked in June, the equity markets actually went up the following week. So we do think it is priced in.
I'd just also like to comment on that, and as far as expectations go and increasing our credibility. One thing moving forward is the Fed needs to be mindful of that. So when we previously stated or let be known that we're thinking about it, we need to follow through with it. And a 25 basis point rate hike is not something drastic, and we don't think it'll have an immediate shock on the economy, but we do think it is prudent, and it's steps moving forward.
And kind of going off this conversation, we do think it is important to kind of taper off this artificial buildup in riskier assets such as equities, and maybe more give investors to move into safer assets such as bonds.
Thanks a lot. My question is, you didn't present the yield curve, but you alluded to it in your talk, and so you have an environment. So I would like to comment on sort of the flattening of the yield curve, how the Fed has contributed, or has it contributed to that, and also what does that mean to you, and what should the Fed think about when it looks like what do you interpret? What's happening?
So your question is in regards to what we should be focusing on with the flattening of the yield curve?
Yeah, and how has the Fed contributed to the flattening of the yield curve, and what could the Fed do?
Well, the Federal Reserve has kept rates extremely low for a very long period of time, which has kept the low end of the yield curve, the shorter end of the yield curve low, excuse me. So there is some geopolitical risk to kind of take in here. There is obviously interest rate risk. We are in a rate rising environment, so that we'll have to monitor both those things as to the long end of the yield curve and see how much that transfers as we continue our rate rising environment.
I'd like to dovetail off that. I mean, per our presentation, one of the main drivers, or the main drivers in declining R-star, according to Krishnamoorthy, Vissing, and Jorgensen of 2012, is the premium for liquidity and safety. So that alludes to what my colleague said in the push towards finding yields in other places, and that's pushing everybody into riskier assets. Because of quantitative easing, we basically stripped that out and we inflated the economy with cheap money.
One of the yield curve that we showed in our presentation is the TIPSIO, the inflation protected one. Right now, we can see the yield is relatively low, showing that people's expectation to the future inflation rate is kind of low, and we think that this might be one of the reasons why the current inflation rate is low. It's not hitting our 2% target.
I mean, I think another reason our current inflation rate might be low is another determinant of our star, which is the savings rate. We see within our economy that in regards to demographics, there tends to be a great proportion of our wealth that is taken up by baby boomers. And with that demographic in mind, their increased savings that they tend to have may be leading us towards the lower inflation rates.
All right, you have time for more questions? So we have a bit of an unusual situation in terms of deciding on monetary policy, and you alluded to that in your presentation. So when unemployment rate goes to 4.1%, all kinds of warning lights are usually flashing. So what's going on? What's your best explanation?
Yeah, well, I can first start off with this question. So, according to the Census Bureau, baby boomers make up about 20% of the population at this point, and unfortunately, they are aging a little more. So, baby boomers are leaving the workforce and retiring, and I can toss it over to my colleague to talk a little bit more.
Okay, so kind of building on that, as you get older, there's less of a tendency to want to switch jobs. So we're seeing with a larger percentage of the working population being older, a decrease in frictional employment, which may be lowering the natural rate of unemployment, which is still, there's a lot of debate about this issue. So there's really no certain definite answer to it. Another factor to take into consideration is the lower participation rate, which we alluded to in the presentation, is historically 3 or 4 percentage points lower than it has been.
I guess to dovetail on that question, I guess if we're seeing the labor participation rate and we're seeing unemployment where it is, how come we're not seeing the wage growth that one would expect from the from applying some pressure? And I guess so. What do you see? Maybe what might be the underlying cause, and then I guess what would your policy implications or recommendations? What kind of implications would those have on wage growth?
So I can start off with this question. So one reason we aren't necessarily seeing wage growth where we'd like to, and then kind of having that transfer into inflation, which is 2% our target. The areas where we are adding jobs at this point aren't necessarily the areas where we're going to see inflation, these being low-skilled workers, blue-collar jobs. These are kind of the areas that we're adding jobs, and not necessarily other higher paid jobs where we would see these wage increases that you alluded to.
if I may add here, we definitely see there's wage growth in the high tech, or computer science field. But right now, as we presented, the job openings in the non-farm positions, they're trending upwards, and that means that there are gaps. This area still needs people, needs talents from all over the place.
And what do you think some of the implications of your policy recommendations could be on wage growth, if any?
Yeah, well, I'm more of the view that I think inflation is more of a transitory issue, and with your question is about wage growth, and I think we're going to see that come as the Trump administration does eventually pass its fiscal policy. We will start to see the unemployment rate shrink further, and we will start to see this wage growth kind of come out of that. The labor market, as I said, is heating up a little bit, and I'm not too worried at this point that it's going to slow down. I think we will see wage growth fairly soon as the labor market continues to shrink down.
Another policy recommendation, I think we should encourage more women to participate in this, into like finding jobs and getting jobs, and push in this way to push the wage growth in the future. Because right now we see the labor force participation rate is decreasing, and I think one of the reasons might be more women are because of like some other issues, they have to leave the job, and we have to encourage more women to participate in this economy.
Another, I mentioned a few policies during our presentation. I mentioned flexible price level targeting, nominal GDP targeting, where the central bank will be targeting a steadily growing level of prices or nominal GDP. I think that there are some implications of wage growth when considering those. Specifically, in nominal GDP targeting, essentially you'll be seeing higher inflation or higher real GDP in those situations. So if our GDP numbers are increasing, essentially we can anticipate increases in wages as well.
I'll try to do two. One, I just sort of want to kick off. The Fed has an inflation target, not codified, but an inflation target that you alluded to in your presentation. What are we targeting? Are we targeting which inflation rate are we targeting?
Okay, so I can take this one. So your question was to which inflation rate we're targeting and kind of why we target it.
Yeah.
So we target a 2% inflation rate as measured by core PCE. And the reason we target 2% is because we wanted an inflation rate that is high enough to still be indicative of wage growth for the younger working population, but we want it low enough so it does not diminish the real purchasing power of the older generation who has to keep their majority of their savings in bonds and fixed income because they need the monthly payments and they can't afford the risk of traditional equities.
So you're all in core PCE.
Sorry, I was just going to talk about core versus headline.
No, we're good. I'll just ask my next question.
Okay,
All right. My second question is, there's talk sort of, you're 8, 9, almost a decade out from the financial crisis, and there's talk about the value of coordinating monetary or fiscal policy. And I noticed, it hadn't dawned on me until you had some of your conversation that you had a couple fiscal policy ideas in there, right? And so what I'm wondering, what you've learned about that, would you suggest that for the Fed? Sort of what your thoughts are on sort of, I sometimes refer to a stabilization policy, right? Sort of coordinating the two. Is that something that you're advocating? Because I know you guys didn't come to a consensus, but I'm just kind of curious if that's where you go.
Well, I can start off with this question. In regards to coordinating the two between monetary and fiscal policy, I think it is extremely important to coordinate the two, especially in the case of a recession were to materialize. You really need to dig out of that, kind of as the case was 2008. But at this point, it is a little bit, they're kind of offsetting as we are trying to, especially me, I'm very much in the camp that we are overheating.
Thank you.
We don't
stop you. Thank you.
Okay.